Hey guys, what's up? This is Ace. I wanted to do a video real quick. I'm going to start doing a series on the different indicators that I have used in the past that I really like, that I think have um, helped to make my trades better. I will preface this by saying indicators, they lag price action. They will always lag price action. And I just want to stress that because so many people who trade, I think, trade based really heavily around indicators. And I used to do the same thing, but I learned pretty early on in trading that if I was getting in and out based just solely on indicators, I would either be getting in too late, I'd be getting out too late because once again, price is always going to perform, and then the indicator will then take that price and it'll do its calculations and it will show you and plot on the indicator. And once again, it always lags price. Now, why am I saying this and stressing it so much? Because in order to be a good trader, you have to be a good price action analyst. Price action and volume are the two most important things when trading, whether you're swing trading or day trading, especially day trading, but even in swing trading as well. I think swing trading, obviously, it's much more forgiving, so you can probably get some better entries and exits if you're swing trading. So for example, I'm just going to show you right here, and I'm going to explain the MACD in a moment, which, like I said, is one of my most favorite indicators. But you can even see here, like if you look at these breakout arrows, you can see that the arrow fired here to say, hey, you might want to look at getting in this trade. And we had a run up, and before it pulled back here, you could have made some nice profits if you would have gotten in right at the arrow on the MACD and rode the trade up. So once again, this is a daily chart that would definitely be considered a swing trade of probably what, like about 7 days or so. You did have some chop here, could have gotten out, might have gotten out here actually. This probably would have scared most traders out, is this doji and then this down candle right afterwards, which broke through the bottom range of that day's candle. That was a big exit signal. I don't think anybody would have really stayed in for this push, but you still would have made some money, definitely, if you would have gotten in, let's say, at the start of this day and you wrote it up. So with that being said, I'm going to discuss the MACD real quick. What the MACD is, and that's this indicator here on the bottom. The MACD stands for Moving Average Convergence Divergence. It's a momentum-based oscillator. Really, it's primarily used to trade trends. It's not typically used to identify overbought or oversold conditions. That's something like a stochastics does that pretty well. MACD is really MACD really focuses on giving you trading signals based on trend and momentum, which is why it's one of my most favorite indicators, because I'm a trend trader. So when I get into a trade, I'm always shooting to be on the right side of the trend, and I want to make sure, obviously, that I can go ahead and see momentum in the trade and when momentum might be waning and when I want to get out. And so that's why MACD works so well for me. Now with MACD, we have a MACD zero line, and that zero line is the white line that you see going across the MACD there. Generally, MACD crossing above a zero line is considered bullish. MACD crossing below that zero line is considered bearish. Secondly, when MACD turns up from the zero line, it's considered bullish, and when it turns down from above the zero, it is considered bullish. So just to kind of explain that, for example, the MACD here is going down, and as it breaks the zero line, that's considered a very bearish thing, and now it's in bearish territory. So consider the zero line as kind of like the line in the sand between the bulls and the bears. If the MACD is above the zero line, the bulls have control. If MACD is below the zero line, the bears have control. You can kind of think of it like that. When the MACD line crosses from below to above the signal line, the indicator is considered bullish, and vice versa. If it crosses, once again, from above down below, it's considered bearish. Now, let me explain something too. We're going to get into what's called MACD crossovers. MACD crossovers are basically these points where you see the MACD actually crossing. Like here's one right here, and here's another one right here. Okay, so those are MACD crosses. Now, In my personal opinion and in my trading experience with this indicator, when you get a bullish MACD cross like we see right here, when you get a bullish MACD cross and it's under the zero line, that to me is a higher risk trade, okay? Because you're literally taking a bullish bias or a bullish outlook on the price of the stock, feeling it's going to go up because MACD crossed, the histogram is pumping up, so you're like, hey, this is a great time to get in the trade. Well, maybe it is, and of course there's a lot of other factors that go into play. You can't just trade off of any one indicator, but my point is it's a more of a high risk trade because you're taking a bullish MACD cross while it's still in bearish territory. Does that mean the trade can't work out? Absolutely not, because look at this trade. You know, if we were to get in, obviously the price continued to go up and some money could have been made. However, though, you do have to understand that when you do take a bullish trade confirmed by a MACD cross and it's below zero, you are taking on a higher risk trade. So my suggestion in that situation would be to scale back your position. You know, don't take on a full position. If your position is, you know, a standard position for you is, and your trading stock is, let's say 500 shares, maybe you trade 250 and, you know, add to that position later on if the move continues. If you're trading options contracts, maybe you trade 5 contracts instead of 10, because you want to limit your exposure, because once again, if it's crossing bullish in a bearish territory, you are definitely taking on a riskier trade versus it crossing bullish while it's in bullish territory. So for example, let's look at this one here, like this MACD crossover. That's crossing bullish, as you can see by the blue arrow, that's crossing bullish in a bullish territory. It's above the zero line. And here's that play. And look at that. I mean, boom, 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 3 days straight up after the cross. That's pretty good price movement, 107.25 to 112. So, I mean, you got like $5 move in 3 days versus down here, this cross of this MACD here, you got the blue arrow firing long, you got 95 to 100. So you got less money. And if you notice, look at all the choppy candles. I mean, you got dojis, you got long body doji, or excuse me, yeah, small body dojis, you got longer body dojis, you have a lot of what I call, how should we say, market uncertain candles. Dojis are always a fight between the bulls and the bears. Even if you got a you know, a small tail doji, or excuse me, a small body doji, that's a fight between the bulls and the bears. There was a lot of fighting going on here, and although the bulls were winning, the bears were putting up a really good fight. But here on this cross, look at this, the bulls just took it and they ran. It was like 1, 2, 3, and you know, you could have gotten in, rode that thing for 3 days, made a really good amount of money, especially if you were on options, directionally on calls, and you had some good deltas on there. Your money would have been made. The same holds true for the bearish side. So if you're going to go ahead and take a bearish position on a stock due to a MACD crossover in bull territory, such as right here. So we'll look at this one now right here. That once again is more of a riskier trade because you're taking a bearish position while the MACD is telling you, hey, I'm in bullish territory here, guys, but the market's going down. Well, can you take that trade if everything else adds up? Sure. But once again, manage your risk on that because it is a riskier trade versus if you were taking that same cross, but it was down here in the bearish area. Okay. MACD divergences are huge. They're a little hard to spot for some people, but they are, when you can spot them, they play off extremely well. Let me see if I can spot one here just on the fly. Here we go. I just spotted one, and I didn't even look for it ahead of this video. So I'm literally just doing this on the fly here. So if I look at this histogram, and I'm going to draw a line from here to here, okay, and I don't know if you guys can see that, but I'm going to try to zoom in here. Okay. So if you guys see that histogram is going down, okay? So that's basically the highs of the histogram are making lower highs. If you look at the price chart and we draw the same lines in the same area, let's just say we'll draw this line from here to here. So what are you noticing? You're noticing price highs are making higher highs. The highs are making higher highs on price, but yet the histogram on MACD is making higher lows. That's called a divergence. Divergence gives you in some situations a heads up as to the fact that even though price is going higher, the momentum in the actual move is dying. It's slowing down. And so what's going to happen when you lose momentum? Well, it's like anything else. If you throw a ball up in the air, as the ball loses velocity and momentum, what does it do? It falls back down to earth. Well, same thing with the stock. As the stock's moving up and it has momentum, it has a chance of continuing to go because there's a lot of movement behind it. When that momentum starts to die, but yet the stock is still continuing to go up, that is a perfect recipe for a reversal. And that's exactly what took place. The price reversed, it moved back down, and we got that nice move down from like, what was that, 112 down to like 102. So we got a nice $10 move down. So divergence trading on the MACD is definitely something that you can do as well. And this works both ways. This doesn't only work bearish, it does work bullish. The difference is just that you would be plotting your lines below price, moving down, let's say, and the indicator moving up. And so here's another divergence. I just discovered it literally just by running my cursor across. So if we connect these two lines here to here, and we connect the MACD from here to here, let me make this good. Okay, what do we have? This is bullish divergence. You know, you have the stock going down, but yet the indicator is indicating, hey, I'm going up. And so when you have that, that is a divergence signal, classic bullish divergence, telling you that the stock is going to go up. And what happened? The stock went up, and you could have gotten in that trade as well. So I hope that enlightens you a little bit. I remember when I first learned about divergence, I was like, wow. I thought it was the Holy Grail. Of course, there is no such thing as a Holy Grail. But I really love divergence. There are indicators out there for Thinkorswim that will plot divergence automatically on your charts for you. I think that's awesome. I personally learned how to spot divergence, which is why I just did it 2 times in this video, completely eyeballing it. I've learned how to spot divergence. I think the best thing is for traders to practice and get really good at their craft, things like that. And then once you know it and you want to put an indicator on to make your life easy, absolutely. I'm going to go ahead and start getting ready to wrap this video up because it is going into 12 minutes and I don't want this to go more than 15 tops. So really the only other thing I want to talk about, we talked about MACD crosses, we talked about MACD crosses in the bullish territory, the bearish territory, managing your risk. We talked about divergence. The last thing I want to close on is momentum. My most favorite thing about this indicator is it tells you if the move has momentum, if it has velocity. And I'm going to just zoom in a little bit here. We're going to look at this really nice impulse move down. And what did we notice? Okay, we had a MACD bearish cross, and yes, it did happen in bearish territory, as we see. But look at the move and look at the bar. This histogram bar shows momentum. This is what's showing the velocity in the trade. So as you see, we open up these first 3 bars here, okay, on the MACD histogram, and we start moving down, okay? And keep in mind, it lagged price action. So if you were looking at price action, you actually could have gotten in here because you see price go ahead and gap up, and then it literally does what I call a bull gap trap, which is where it gaps up bullish and then it closes to the downside. And that next candle was a beautiful continuation. It took out 4 days of previous price action, plus it went ahead and took down about 75% of this big green thrust candle. So I mean, that was just amazing. And if you were watching here, you could have actually probably gotten in pretty early in the morning and gotten a lot of that candle. But back to my original point about momentum. The MACD goes ahead and signals you here, and then you go ahead and you write it down. Now, if you're looking, let's just look at this whole area right here, okay? If you're looking at that indicator, you're going to notice the bars are bright red, and then there's like a darker red. We have a darker red on the 4th and the 5th MACD histogram bar. Those darker reds are basically waning momentum. So when momentum starts to fade, the bars turn from bright red to dark red. Now keep in mind your platform may have different colors. My platform's set up this way. And then you'll notice as the actual trend continued down, the momentum really picked up here and it accelerated. And along with that, look at the lines. The MACD line and the MACD signal line are actually separating. That is a clear sign of momentum coming into the stock. The further apart those lines are, the more momentum is in the actual move, which is why you see right here how wide these lines are far apart, and you see the bright red histogram. There would be no way I would be getting out of that trade. That is just a beautiful trade. You could have ridden it all the way down to the bottom, and then you could have gotten out probably somewhere earlier in the morning on that green candle, maybe even in the afternoon. You could have gotten out and you would have had yourself an absolutely amazing trade. Anyways, I'm about 16 seconds or so over the 15-minute marker for my video, so I'm gonna go. I hope you guys enjoyed this. This is the first of many videos I'll make on indicators and my analogies and interpretations of them and how I like to use them. If you guys got any questions, definitely post it below. Make sure to like this video, make sure to subscribe to my channel, and leave me any comments on anything you'd like me to do videos on in the future. And I hope you guys have a great day and trade well. Talk to you soon. Bye-bye.